In the first 30 days of 2026, the American economy hit a grim milestone. Nearly 600,000 jobs vanished, but we're not in a recession. Amazon just reported over $50 billion in profit, yet they're eliminating 30,000 corporate roles. UPS is doing the same, slashing 30,000 positions while they shift to mega hubs. Why is the board being cleared of players while the bank is richer than ever? Because the rules of the game have fundamentally changed. We've entered the efficiency era, where our very livelihoods are being traded for AI servers. Welcome to Econopoly, where we break down how the economy actually works, using real data and simple explanations. For years, the winning strategy for corporate America was growth at all costs, and in some ways it still is. But today, the game has a new rule in focus: financial repression of labor. In the old version of the game, layoffs were a sign that a corporate player was in financial trouble. Today, layoffs are a signal of strength to Wall Street: capital discipline. Companies are no longer judged by their size or how many people they employ, but on their revenue per head count. Every salary is an operating expense, or OPEX, that burns cash every month. But an AI agent, or any automation tool, is a capital expenditure, or CapEx. You only pay for it once, it never sleeps, and is a tax write-off. The 600,000 people who lost their jobs in January were liquidated to fund the big pivot to AI. This pivot creates a self-reinforcing loop. We call this the velocity spiral. When a company like Amazon announces they're cutting 16,000 jobs to simplify bureaucracy, other players on the board, from Microsoft to Citigroup, see this. They realize they're being penalized by investors for being inefficient. This creates a 42% increase in layoff velocity. If they don't cut their staff to fund the AI transition, the market will move its capital to a player that will. It's no longer a game where a company asks if they can afford to fire workers. It's a question of, can they afford the opportunity cost of keeping them? Let's look at the two biggest moves at the start of 2026. UPS is cutting 30,000 jobs this year. Why? They're closing old facilities and moving to automated mega hubs. They're also unwinding their partnership with Amazon. They're trading low-margin Amazon packages for higher-value healthcare logistics. A company with better technology and fewer employees means bigger margins. Now, let's look at this AI pivot through our bullish and our bearish scenarios. In the bull case, we see a productivity boom. In the near future, these leaner AI-driven companies generate so much wealth that they trigger a new digital golden age, creating billions of profits and higher-tier jobs in cybersecurity, AI maintenance, and human-centric services that we haven't even thought of yet. The bear case, or bankruptcy trap, is the knowledge drain. By firing the institutional memory of the company, which resides in the workers and the middle managers themselves, these firms risk stranded assets, processes that no one knows how to fix or improve if the AI fails. Also, if consumer demand drops because 600,000 people and more are out of work, these companies will have mega hubs with less customers and nothing to ship. So the 2026 layoff wave is a structural capital remix, where the largest profitable companies are trading human payroll for automated infrastructure. Time will tell if this is a bubble or a smart strategic pivot for a small number of companies to win the AI arms race in their sector of the US economy, ensuring they have the biggest market share in the AI economy of the future. Subscribe to Econopoly for clear, data-driven explanations of economics and markets.